Hello folks, welcome back. This is the market review for July 28th, 2020. And again, these are temporary, so don't get used to this. I know you guys are getting really comfortable seeing this on a daily basis, but I'm only going to continue around, like I said, the second week of August, and we'll return back to Wednesday and weekend weekly reviews. But those videos will be longer in duration. Okay, so alright, so we're looking at the dollar index on the left-hand side. It's a 15-minute time frame. We're only going to use 15 and 5-minute because everything else that's been mentioned on the higher time frame is still in play. So we're focusing really on the intraday volatility around those key levels that's indicated on the charts now. So dollar index, we've been consolidating as we were expecting today, and we've worked a little bit on the downside on the weekly low that I've outlined and showed in the last few videos. We have relative equal lows down in here, and let me scrunch this up. I know I can take this thing off down here, but if I do, invariably I'm going to need to use it again, so I leave it there and struggle with it. But we have the low here and the low here. This low is higher than that one. Okay, you see that? Okay, so it still sets the stage for a low resistance liquidity run. Where does it need to trade to in here? On the short term, I'm watching right here, right there. Okay, so if it trades above that and comes back down and finds support, it may need to come up a little bit deeper, and that would send Euro down below this low here and clean up some of this busy buy side imbalance, sell side inefficiency. Euro, as I mentioned, much in the same way I talked about on dollar, consolidation is the theme. And you can see that happening here. So we ran above the rejection block on a weekly basis, swept it, and then came back down below it, and now we're contracting again. Overall, it still could trade higher. It just may need to stay in a range between this low and this high for a little while. But if it breaks this, we have to put all of our focus on this BISI here, because this one single candle is holding up all of this price structure. So it would be better if this stays open. They don't take the sell side liquidity out here. They could run it on a shallow basis and get these here, and that's fine. They can come down and sweep that, use this order block, but keep this low intact. It's really thin, basically, just to run these lows here and leave that one intact. But if I were making Euro, that market would be ran by me with just shallow runs below here to upset the sell side liquidity and then slam it up in here above these highs. The high over here is higher than the latter one, and that's our signature. We want to see that. That sets the stage for a very low resistance liquidity run, should it find legs to go higher. I'm still hands off on Euro, so take that with a grain of salt. You know, I'm not looking for anything in here to trade. I want to see it give me another leg of displacement, and then we'll have something to work with. I want to drop into cable because that was the one I pointed to and said it has a little bit more upside. Alright, so here's cable, and we're working again with the 15-minute time frame. We have a low, equal lows, sell side liquidity tapped, bullish order block, runs. What do we have here? Buy side liquidity, relative equal highs, really clean. I mean, these are almost identical. So when we traded down below that, this is what I want to kind of like teach today. If you're expecting a run above relative equal highs, the easiest way for you to find setups that are going to be, let me choose my words correctly here and not just reach for the first thing that jumps to my mind. If you want something that is high probability and less likely to fail, okay, this is one of the things you look for. The time frame on this market structure and the way the institutional flow is showing here for 15-minute, your 15-minute chart has to be the lowest one you're going to go for, because 5-minute charts can fail, 1-minute charts can fail a lot. 15-minute tends to have a little bit better delivery in terms of consistency. Now, I know some of you are like, well, wait a minute, price is price. Right, price is price. And it's uniform and universal across all time frames. But even if I work with an hourly and I work with a 4-hour and a daily, I can get the higher time frame draw and liquidity. The lower time frames, because they are lower time frames, they can stay in a mode of unlikeliness. Okay, in other words, where we are seeing euro trading on its 15-minute time frame, it's consolidating. Okay, it's not really doing too much. This is being held in consolidation, which is what we were expecting. But cable is allowed to trend, or it's making a continuation on the upside. The upside is that daily fair value gap. Let me scrunch down a little bit more and you'll see the top of it. So here's the premium end of the fair value gap, discount end of the fair value gap, and we're just crouching right below that. So we're going to see if it has the ability to find momentum to get up in there, and that's where I'm looking for. 130 is good. It doesn't have to even trade the consequent encroachment. So we have sell side liquidity here. It runs through that and then trades higher. Most likely afraid to do these types of trades where it trades under the lows. As it trades under there, you're afraid to buy that. And that comes by practicing. And there is a function on TradingView, and it's right here, but I don't have my screen set so you can see it. It's a little tab on TradingView. It says replay, and it has two little arrows pointing to the left. You can practice with that and train your eye to see it. Now, it's not the same as actually watching. You can practice with that and train your eye to see it. Now, it's not the same as actually watching the candles form. So that's why I always say, if you have the ability to invest in like Cam Studio or any kind of screen recording software, they're not expensive, folks. But even if you could set it up to record your screen on a lower time frame, or if you split the screen in half like this, there's a little toggle up here. It gives you a choice. I think you have to be pro on TradingView. I don't think it's done on the free level, but it's not expensive either to get pro level. I mean, really, in my opinion, they should make it available, for everyone. But whatever, it's their business. But you can do the split screen, and if I click on it, yeah, so it gives you the choice here or here. And the membership level I have just is Pro. I think it's Pro Plus or whatever. I'm not trying to sell you anything. I don't have any affiliation with TradingView, so please don't get that twisted. But you're only usually seeing it with one chart layout here. I'm using this one, so that way it speeds up in my mind. It may not be because I'm getting long-winded today, but it speeds up the videos where you can see both things. And you can also compare the relationships between the highs and the lows in the markets I'm discussing. So anyway, the run below this low here, if you can train yourself to practice, when you're bullish, as it trades underneath that low, this candle at one point is going to be a bold flush, no tail at all in the bottom, and it'll be below this low. That's when you want to be entering with a demo account. Okay, practice doing that over and over and over. You can do a lot of examples of that with a 1-minute chart. Now, for some of you that don't have the luxury of being able to do that, you can record your screen and watch the actual candles paint. Whereas the replay button that you use with TradingView, it just gives you the full candle at the time it closed. So that's how I used the folks that used to say, well, yeah, your examples are just using replay on TradingView. No, there's no countdown on the candle, and the candle completely forms as it's posting. You can watch in my trade examples where the candle's painting as it goes up and down in the same candle. So I want you to understand that there's ways to practice this and build a confidence about doing this, but you're never going to get it by just watching my videos. I mean, I could literally do this every single day in front of you live. And just watching me do it is not the same as you going in and practicing it. Okay? So it's one of those things that it can't be transferred. Experience cannot be transferred. It can be borrowed. Now, you can watch me do it and piggytail on the trades if I did them in front of you live. But again, that's not the same as experience. What that does is it gives you experience in copycatting and piggybacking, which builds the experience in trusting my decision making, my ability to pick the levels of the entries. And that's not the same as you getting in here and practicing. It doesn't feel fun, okay? It isn't going to feel fun. It isn't going to feel exciting. It's scary, and some of you probably are afraid, and that's really the most apt description of what it is. You're afraid to see yourself do this and not do well. But it's practicing. That's what practicing is. You want to be practicing in an area or an arena that doesn't allow you to hurt yourself financially, and no one else sees the results. Folks, listen. In the 90s, I was a floundering mess. Okay, I had no idea what I was doing. I was buying and selling 20 different times in the same day, in the same market, thinking I was wrong, I got to reverse. Thinking I was wrong, I have to reverse again. Oh, now I got it right. Focus on one side of the marketplace. I took your attention and put it up here on the fair value gap on the daily chart. Okay, when I talk to you and I point to something, if it's above the marketplace, your focus should be what? Shorting the market? No. You need to be focusing on what would lead to an idea on a discount array, something bullish, okay? It could be a run below old lows. It could be a closure of a fair value gap, or it could be a bullish order block, or it could be a bullish breaker, okay? Something that you can frame the idea of bullishness on and link it to a time of day and entry that makes sense. Now, hopefully you guys can see that the low here up to this high here and trading back down, that's optimal trade entry. I'm not going to put the fib on there. You can do that on your own charts. By itself, we are in a discount market. Now, that's your minimum for high probability. It has to be that way. Well, let me rephrase it. First thing is you have to have a directional bias. Okay, which side is the market likely to work? IPTA is likely to go higher or it's likely to go lower. Why? What would constitute the reasoning behind the market trading up here? Well, it's a fair value gap. We've been bullish, and it has not traded up there yet. And it's a logical level to reach for. It's not an absolute. It's not a going to happen period in the story. You know, it's not a 100% likelihood. But we work within that narrative, and we accept the fact that we are not going to be 100%. I'm going to be wrong, you're going to be wrong, you're going to miss trades, you're going to get stopped out, you're going to have losses. That's going to happen. So every time you go into the marketplace, whether you're practicing or when you eventually get to the point when you decide that you're going to trade with live funds, you need to do this on the basis that you have proven to yourself that 1, 2, 3, or maybe even 4 or 5 losses will not undo the soundness of the model. Your trading plan and your model is not hinged on the basis of being perfect. It's not hinged on the basis of it being, you know, without losses or a series of losses. If you're going to be a high frequency trader, if you're going to be in these lower time frames trading every single day, you need to expect losing streaks. And it's okay. There's nothing wrong with that. It just means you got it wrong there. And that's why you don't want to risk too much or arm wrestle the marketplace. But by practicing and using resources, and it may begin with you getting a screen recording app and watching the video after you come home from work or whatever you're doing that distracts you from actually doing it live, and then you can sit there and watch it. Grab yourself some dinner, grab yourself a drink, sit down, and watch the candles paint, and have the charts in such a way where you can see when it's actually trading down in there. Annotate the charts, as best you can in advance of what the kill zone that you're working within, and you want to put them like really high up and really, really low, so that way it's not in the way of the price action, but still you can reference it in terms of time. And the way you simply do that is that you just scroll over here and draw the lines in advance, like for tomorrow. And before you go to work, just double check you got enough room in case it moves around a little bit more than you anticipate, and set the recording and just walk away. And in an evening time, you'll have a very, very long recording, and you can do so many things. You can actually annotate those videos and create a video study journal, which to me, that's like the best thing, because you can literally annotate the charts and say, look, this is what I thought was going to happen, this is what happened, and then you can also annotate the chart with the with the recording of the video and show what you're supposedly gleaning from it. And then you can watch the video on the weekend, and then you can see the annotations. And what that does, folks, It's the same thing as what I do, and I teach you all to do with having your case studies. Okay, when you're getting all of these examples every single day annotating your chart, and then when you study them on the weekend, what you're doing is you're programming your subconscious mind to see these very things that you may not have saw at the time of the recorded event or the live event in trading. It makes a pseudo experience. Okay, and it isn't fake it till you make it. That's not what this is. It's training your subconscious. You're activating your reticular activating system. It's the same thing. I'll give you an example where if you buy a car, the next day you start seeing that car everywhere. It seems like everybody went out and bought the same car you did. And that's not true. It's just now you are now allowing, your subconscious is allowing, whereas otherwise it would have filtered that out. It's allowing that to come in and your attention's drawn to it. So by doing that, by seeing repetitive things over and over and over again, and your way of creating a study journal is a mandatory thing in this mentorship, because that part is what the real learning is going to come from. I'm guiding you into seeing what you should be seeing in price. I'm pointing in the right direction for you in the weekly reviews and the daily reviews. I'm pointing your attention to things. That is the gentle nudge, okay? Like if I was a baseball coach and you're at the bat, okay, and I'm teaching you how to swing to hit the ball, I'm not swinging the bat with you. I'll take the bat in your hands and mine, and I'll stand behind you, and I'll just swing that bat to show you where you should be swinging to. But I'm not going to strike the ball. You are. You're expected to do those things. Well, in the mentorship, this is why a lot of people quit, because they want it to be, show me a video, I learned how to do it, and there it is. You can't learn how to ride a bike by watching someone do it. You got to get on it and fall off and experience what it feels like to lose your balance, and then what it takes to shift your weight to hold on to that balance or regain that balance. And you have to have courage to get back up when you skin your knees and your elbows and hands, and it's not fun. That part's not fun. But once you learn it, think about it. I'm quite confident there's some of you in here probably haven't rode a bike in a year. Did you forget? No. You know exactly how to ride a bike. You know exactly how your weight's going to have to be shifted to maintain that balance. The same thing occurs when you accumulate this insight, because once you train your eye, when you're bullish, when it's trading under these lows and you do a exercise where you buy that and you have relative equal highs to target for an initial target, you're going to buy there and take something off as soon as it runs above these equal highs. So right on this candle here, right on the wick of that, you would take something off. You have to train yourself to do that. And then once you do that, the stop that would be placed from the entry here, which would probably originate below here, then you can take it up to here, because we've already left an area and moved into an area of buy-side liquidity. So we're now in a different state. We're not in a discount market. We are now in a premium market, and we will allow the market to stay in a premium and work towards a higher premium, which is the fair value gap on the daily chart. But when you cannot, say your psyche will not allow you, and there's nothing wrong if you cannot do this part, okay? Some of you will just simply never have the willingness to buy under lows, even if you're bullish. You just won't be able to do it. That's fine. That means your strength is going to be working within internal range liquidity, whereas this is external range liquidity. Internal range liquidity would be the movement into here after you have confirmation. Okay, so what does that look like? You anticipate it going underneath these lows, but you may not be willing to take the trade there. So you want to see, does it have a reaction there and break higher, taking out a short-term high? So once this high is taken, after it's taken out sell-side liquidity, IPTA has changed its state of delivery. It's no longer seeking sell-side liquidity. Now it's going to be seeking buy-side liquidity. Where does that reside? Here. And above that, on a higher time frame, the fair value gap. So when the market breaks this short-term high, even though it retraces, we're not looking at this retracement as this is an optimal trade entry. It's a sell short. No. You would be looking for what? Up here is where I took your focus. Okay? You do not lose sight of that. Once this high here is broken, you have to use a 15-minute time frame for these types of setups. And what I mean by that, at the beginning of this discussion on the pound, I said for high probability and for setups that are less likely to fail, you'll have to find this formation and framework on a 15. Why? Because you can drop down to a 5-minute chart and then use the lower time frame order flow inside this narrative that we've taken stops, we've broken structure here. Any drop down, it's going to be reaching for what? Bullish order block, fair value gap. That is all you need. If you're bullish, you have an objective on the upside, and you have the framework like we have here. We're in a discount, we've taken stops, we have buy side liquidity left in the marketplace. When the market trades down into it here, we're going to drop down to a 5-minute chart, but I'm going to annotate that little area right in here because this is the focus of our discussion and what makes the setups. I'll put it there. That's good. So I'm going to drop into a 5-minute chart and you'll learn something here. Alright, and make this a little bit better. Alrighty. So, after that low has been swept, which is what we see here, okay, the market breaks above that short-term high. Once this high is broken, there, on this candle, you wait to see if it comes back down into a discount array. Here's your bullish order block. Here's your fair value gap. So you can be a buyer on the opening or the high of that candle, which comes in at, we'll use the high, 28.65. Okay, 28.65. Prior to this order block, where is the 5-minute swing low? Right here. See that? We have a high, a higher low and a higher low to the right of it. So this low is surrounded by a candle that has higher lows on both sides, right? So that's the swing low we use, right? No. We can use this one. Now you might be saying, "Oh, it isn't big of a deal," But guess what? If you're using a hourly chart and that's going to be your framework, and you don't use anything less than that, this could be a lot more pips than you'd be probably willing to take, and you may not want to take that trade. But we have a swing low here. The candle to the left has a higher low. The candle to the right of it has a higher low right in here. So your stock could be just below this candle's low at 28. We'll call it 28.43. Okay, so 28.43 your stop. The market trades down into this candle's high at 28.65 and a half. The low on this candle comes in at 128.67 even. So if you use this candle, order block and high, add 5 pips to it, you're going to get filled on this swing here. The market trades up again, consolidates, drops lower. If it drops down like this, you do not get fearful, oh, it's going to run from my stop. Because at this point, you have a swing low. Allow it to trade down there. You might have a little bit of drawdown. That's normal. There's nothing saying it. Once you get in a trade, it starts to rip immediately in your direction. That's ideal scenarios, but ideal scenarios don't always occur, which is the reason why you have to have a minimum with me for a full year, because you're going to see when there's periods when I need to see the market do certain things because I'm reluctant to follow what it's giving me. But when you watch these things unfold, this sell side liquidity that's getting taken out right here, in your mind you're saying, okay, all right, it's got a low it can take, and my stop's down here. I'm not worried about my stop. If it takes my stop, so what? But I'm watching as it drops down below this low, and I want to see, does it have a willing, I'm giving you the internal dialogue or hypothetical dialogue that you would be having. I want to see it go below there. Yeah, that's fine, but then I want to see it torque up and get back above that low, which it does almost immediately right here. And then what you want to do is follow your school of thought, which is, okay, here's your next buy-side liquidity pool. Should it reach for it? Yes, it does. It reaches for it. And let me take this box off because it's now in my way. We have another fair value gap right there. Okay, see the high on this candle and the low on this candle. Small little portion right in there. Okay, extend that out in time. Where's the bodies being respective? Inside the fair value gap. Yes, you get a tail. Who cares? Again, that's broker related. You have to have the willingness to absorb some adversity in your entries and in your trades. You have to, because if you don't have that, you're not going to do very well in this. It's going to be frustrating, and you're going to just fail, basically. I mean, there's no other way about saying it. Just you have to be flexible. The market trades down into that fair value gap right here. This whole business right there, what is this whole setup? That little tiny framework right there into that candle. What time of day is that? 5 minutes after 9. There you go, using the bodies of the candles inside the swing. Trades down to 62% retracement level. So now you can start doing standard deviations for your New York setup. We're in the New York kill zone. We have stops rated, and we have another level of stops rated with a bullish bias, equal highs, and the fair value gap that's on the daily chart as an upside higher time frame draw on liquidity. Creates an optimal trade entry here and rallies. If you don't take that one, you can take this one here. Here's another one. We have the run to this fair value gap there, and it breaks this short-term high. So the same process repeats all over again. You take the fib. Does it frame a discount? High to low. 50 is here. It trades below it into the fair value gap right there. You can be a buyer there. And the same thing. Start looking for your standard deviations on the upside. The market is traded to here. So is it likely that you're going to find this set up a few times a week? Absolutely. Absolutely. Back in 2010, when I was really just pumping things out onto baby pips, I mentioned, and I still hold this view today, that the New York session is the absolute easiest trading session to trade. And if I were to have a local university, okay, say I open up a university and I brought people in and they spent a semester with me, and we taught really deep price action and everything. Like, say I was like a daily lesson, like mentorship level, every single day, and it was for a semester. I would be teaching primarily how to do what I'm showing you here. That's why I teach it on the YouTube channel as well, because I believe wholeheartedly that the New York session is the easiest one to work within. It's so easy. It's like you really have to mess it up royally, to miss at least one or two moves a week. I'm not saying you're not going to have losses, that's normal, and you might get the bias wrong, and it may not deliver on that bias that particular day, but you don't abandon it, and you stick with the narrative. And these are the things that are in the charts that no one, they're seeing it now, obviously, because I've made it public, but the point is, this has always been like that. And no one has wrote books about it. No one has made courses about it. No one has anything like this where it's time and price oriented. Now, if you're IML, you're saying it's price and time because they just reverse it because it makes it sound like it's original. But it's time and price. Okay, you wait for a particular time of the day, and or day of the week, and or month of the year, or quarter of the year. See how seasonal influences have an impact on all that? But then you break down price relative to that time element. And what are you looking for? What is the price reaching for? What is it likely reaching for on a higher time frame level? That means weekly or daily, or at the lowest 4 hour, because you may not get a good read on the next level for upside or downside liquidity on the daily. It may be a far distance between where the current market price is and where the next PD array is, above or below the market price. So you would have to drop down from the daily to a 4 hour, and then right away you'll see there's more PD arrays that you can work with that are still salient but just aren't as extended into the realms that the daily chart may or the weekly chart may be suggesting. In other words, what I'm saying is, if you're looking at the current market price, and if you're using just the daily chart, and it may be reaching for an old high, that old high may be 500 pips away. That's not a reasonable premium array for near-term trading. Okay, so near-term day trading, short-term trading, using a 4 hour chart, you'll see levels that are going to be more relevant, okay, or more applicable than that of a daily chart that has very wide PD arrays before it would get up to that level. They're long shots. Okay, that's why I don't like to trade position trading. I can get a lot of turnover and velocity using lower time frames and short-term trading, whereas somebody that's holding out for, I got a 50R trade. Okay, congratulations. I've made 5R on 30 trades since you held that trade. There's no comparison. Velocity kills every system out there. And when you add ridiculous money management, it's crazy insanity. It's nuts. But you have to learn a lot of things, because if I give you those tools, you're going to go out there and blow up, because you're going to think, well, okay, I'm going to be right on 3 times out of 5, and I'm just going to go as hard as I can because I need to quit my job. You're going to do the same thing I did, and what everybody else does too. You give somebody a live blade, okay, and you say, okay, we're going to learn how to do sword cuts, okay, or drawing of the blade, and that person is going to hurt themselves or someone else. Period. End of story. It's going to happen. But if you use a Vulcan, which is, it doesn't even go into a scabbard, it doesn't go into a sheath of any kind. It's wooden, and it teaches you balance, and it teaches you technique, and it doesn't harm the practitioner or those around them. And you learn the skill set of holding the blade and working with the blade and doing the cuts. Well, instead of Iaido, which is what I'm describing there, it's Forex. It's no different. You don't want to harm yourself before you give yourself a chance to be good at this. And believe me, you are right where you need to be exceptional. But as your teacher and your mentor, it's important for you to understand that there's going to be a lot of effort on your part that's required, and patience. Think about it. New York session right now, it's 2:47 p.m. Eastern Standard Time right now. You have to wait until tomorrow in New York. But is there any uncertainty about when a setup's going to happen now? No. You know. There's going to be a trade that takes place between 7 o'clock and 10 o'clock in the morning. There you go. Boom. Simple. It's going to be there. The question is, what direction are you working with for that particular day? Because the bias isn't always evolving. It isn't bullish one day, bearish the next day, bullish, bearish. It doesn't. We stay with one side of the marketplace. That's working within a narrative. It doesn't mean that you won't have a down close day. And down close days when you're bullish is still good, because if it trades above that at a later time, that becomes an order block that's bullish. And it can be framed upon another short-term entry, which would suggest another propulsion higher in magnitude should it trade back down into it. Not upsetting the order flow, because a long series of daily candles in one direction isn't always up-close candles. You may have 1 or 2 or 3 down-close candles, but when they breach them on the upside, they become bullish order blocks. So it feeds on itself. Everything's supported by the algorithm. The algorithm is not just, hopefully by now you can see, even for the folks that are month 2 going into month 3 now, because that's our youngest group in here. Hopefully you see now that there isn't a randomness to what the market's reaching for before it turns. I'm teaching you how to time the market, see where those turns are going to occur and where it's going to reach to as a target. And that's very powerful. When you strip it down to its basic tenets, that's what everybody aspires to know when they buy these courses and books and see people teaching webinars and seminars, and you go to these live events and workshops and such. So many people go to those things, and when they come out of there, they got all this excitement about what they thought they learned, but then when you go home, or you try to do it with your own resources, you can't replicate any of that. That's not what you're finding here. What I'm showing you is the truth. That means these things happen over and over and over again, and they look similar. They don't look identical, but they look so similar that, just like that car analogy, okay, your subconscious is allowing these setups to be identified at the time of their formation. So that way you anticipate, oh yeah, it's going down to that fair value gap, it's bullish, it's already broken here, I don't think this is a rejection and trade lower, because that's what Turtle Soup is in the Street Smarts book. Okay, I really wish I wouldn't have adopted the name Turtle Soup. It just stuck because I was trying to teach people what I saw from that pattern. And like I said, if you look at the book, I don't trade Turtle Soup from the Street Smarts book. I like the idea of it, okay, but in certain market conditions. But you've never seen me use a 20-day high, break above the high, and then sell short there, or the very next day, which is turtle soup plus one. That's what their book teaches. And I think it's a great pattern, but the idea of stop runs, okay, that book helped me really start seeing a lot of that idea in the marketplace. And it, like I said, it was an inspiration that led me to deep study of where pools of liquidity would be, and internal range and external range liquidity, which is not talked about anywhere else except for here. So while there is an understanding of liquidity pools, okay, which are not anyone's invention, okay, I didn't invent that, but the way I teach and interpret my, I guess, perception of where that liquidity would reside, that's unique to me. So when we look for those things in price, and you couple that as a target, or maybe in this case as an entry, what I'm saying is what makes these setups high probability and less likely to fail is, number one, you have to have a bias that's bullish or bearish, okay, and stick with it. Then you wait for that time of day when you should see some interest, okay, for the algorithm to want to go up, if you're bullish in this case. So if it starts by going down, okay, great. What's it going to do once it takes this low out? You may not have the courage to even buy it again when it goes below that low. There's nothing wrong with that either. But when the market breaks higher again and takes these highs out, look for an area where there's a down close candle, a gap, fair value gap, okay, and then when it trades back down into that, you can be a buyer there and just hold on. And don't worry about your stop loss getting hit. If it gets hit, so what? Then when you take the paper loss and in your annotation say, okay, this was a losing trade. This is how long the trade took to stop out. My entry was at this time. This is how much in terms of pips I saw at any given time. Was it ever in profit, or how long was it before it immediately went right to my stop? All those things, because you're going to find by doing that. So you're afraid to see those types of results because it's uncomfortable. I don't want to see that. I want to see the things where I get in there and it runs 30 pips in 5 minutes. That's the same thing I had, folks. Okay, but you cannot do well in this industry unless you train yourself to absorb and weather all of the things that you're going to have when you start trading with live funds. That means getting in a trade and it doesn't run away, take off in your direction right away. It may go in against you a little bit. But if you don't have these skill sets in mind, okay, and allowing, okay, when the stops are taken here, and we just had another level of stops taken here, and you're buying down here, that should be a great deal of confidence for you that we've already did 2 layers of sell-side liquidity. We did this one down here, and we did this one here, and we're still inside of what? This candle here, 5 minutes after 9. You are still in the hot zone. Like, you really are still where that New York setup is going to unfold. So you should have confidence that by buying in here and in these conditions, you're likely to see the market trade higher. And I promise you, if you do these types of things, okay, where I point, you focus. It's not a signal service, folks. I'm teaching you how to practice so that way you, by experiencing the things that I've taught you conceptually, you're supposed to be putting these things to work. You clearly can see I can do it. You need to learn how to do it. And you cannot borrow my experience for that part. You have to do it yourself. And if you're one of those individuals, and I know there's a lot of you probably just would never admit to it, you are afraid to go through the uncertainty portion of the practicing. I was too. I hated it because I felt like I was doing everything wrong. And the only thing I was doing was learning. But I wasn't allowing myself to do that. I was not allowing myself to do that. But I read a book from Tony Robbins, and some of the things that he mentioned in that book. Now, don't get me wrong, I'm not a real big Tony Robbins guy, okay? But back then, I was looking for anybody that would just give me some inspiration. And some of the things he talked about in one of his books, and the title escapes me right now, but I think, if I'm not mistaken, it's Awaken the Giant Within, or something to that effect. If you do Google search on Giant in Tony Robbins' book, you'll get the title, but I think that's real close to that. But nonetheless, that was one of the things that inspired me to say, hey, look, I'm messing up, but it's just like working out. You do the last couple repetitions in a set, and you can't get that barbell up to do that last curl, but you keep going until you fail. And that failure is a sign that you just simply exhausted your muscle. Then all those previous repetitions that you felt that were okay, those were doing nothing for you. It's those last few repetitions that are actually doing it. It's tearing those muscle fibers, which allows it to grow stronger. Well, when you practice, you're going through that same growth pain. You're doing things that aren't giving you an immediate feedback that feels good. Sometimes they will. But you're learning how to weather the storm and stick within a narrative. And when you see these things unfold and you have 2 layers of stops taken and you're bullish, you got a loaded deal. Like, that's a loaded deal. In other words, Larry Williams wrote about it in his book. It's called a lead pipe cinch trade. And the first time I read that, I was like, that's the trades I want to look for. That's the ones I want. And I went in there and looking for COT trades to be like an everyday type trade, and it wasn't working out for me because I was trying to do too many things and demanding immediate, feedback. That was always positive, and I wasn't willing to accept the negative. And the negative is what I learned 6 years, of going through all that crap. I figured out that I was learning what I should have been focusing on and how to avoid these reoccurring issues and mistakes in my analysis and my losing trades. The answers were always there in front of me, but because of my insatiable desire to want to be right all the time, to be accurate all the time. Like, I have always aspired to be highly, highly accurate because I don't like being wrong. I like being right. I like to win in arguments. I like to have control. Okay, these are all central tenets to me because I have obsessive compulsive disorder. And I don't trust anybody else to steer for me. When I go somewhere, I'm driving. I can't ride with someone and get car sick because I don't trust their braking. I don't trust their steering. I don't think they're going to watch the road enough. It's just, I have to be in control. So what was odd, I was in control of my learning in the beginning, but guess what I was doing? I was relying on a new book, a new author, and a new style or a new set of indicators and settings to be the one in control. And I was never really allowing myself the first couple of years to really learn. I really didn't give myself a real chance to do that because I was always confusing myself and leading myself down the primrose lane, thinking that, I'm going to keep doing the same things over and over again and it's going to eventually click. And it didn't. It never did that. It never did that. So when I focused on what I was doing wrong, I made a very annotated journal entry about the things that were occurring and what I was believing what was going to happen in the chart. And it was not fun to do that. And I didn't fill it with, I suck or, this effing chart. None of that stuff was in my journals. I had enough understanding that would just be toxic thinking. And that's going to constantly be in my viewpoint or my analysis. And I'll link back to it fearfully, but on a subconscious level, and I'll find a perfect distraction. Have you ever noticed that? You've seen, maybe you're looking at New York, or maybe you're looking at London, and you have an understanding of what you think might happen, but instead of just taking a demo trade and getting there and getting the experience, you start looking over there, oh yeah, my CDs are out of order. Let me go over here and start messing with this. Oh, well, the dog, I didn't take the dog out. Let me go over here. And then all of a sudden, what you're doing is you're indirectly distracting yourself, and you're procrastinating because you don't want to be wrong. But man, does it feel really good when you come back in from walking the dog, say, okay, got that out of the way now, and you sit down and it moved exactly like you thought it was, and you're like, yeah, man, you feel good. That shouldn't feel good. But see, what you've done is you've replaced, an opportunity to practice, engage that moment where it's uncertain, and then now you're coming back and you're saying, oh yeah, I was right about that. And you do what? What have you done? At that very moment, what have you just done? You did it wrong. You did it incorrectly. And I did this for years, for years on a daily chart. I would say, I want to buy corn, but, something would distract me. And then all of a sudden, I'd look at the charts at the end of the day. Hey, look at that. I was right. No, you're wrong. You're absolutely wrong, Michael. You didn't do what you're supposed to do. And if you're doing this, what you're actually doing is you're training yourself to always be distracted on the basis of fear. You're being fearful of being engaged. And you cannot be a profitable trader unless you can engage. What does that mean? If you see a setup and you see this down here and you got a fair value gap and everything looks like it should go up and it's down here just like this and it creates this candle here and it starts and this candle closes and this candle opens up, you should already be in a trade. You should be in it. But if you don't and you allow something to distract you, what have you done? You've wasted an opportunity to get real engagement and experience. Right or wrong, doesn't matter. Because believe me, getting in a trade was something I had to force myself to do. I was scared. I was so scared because I was afraid, what if I'm wrong? And nobody even knew I was trading. No one knew I was trading. When I first started in 1992, no one knew when I opened that brokerage account with Fox Investments. No one knew I put a trade on in orange juice, buying an option. No one knew that. But it felt like the whole world was watching me. And whatever it is in your mind that's making you fearful, you need to tackle that. And the only way you're going to figure that out is by journaling. Talk to yourself in your journal. It's all self-talk, but you never give yourself permission to be negative. Always focus on the positive. Identify the things you did wrong, but just simply very matter-of-factly just say, this is what I did wrong, and I need to pay more attention to that. Okay, period. End of story. It's not a beat-up session or anything like that. But getting back to what I was saying, if you don't engage at the moment when you should be practicing or entering, okay, if you're not doing that, what you're doing is you're teaching yourself that being afraid is right. Because remember, the example was you took the dog out. When you saw the trade setting up, you didn't set a demo entry in, you didn't put your stop in, and then watch it like that. You said, well, I gotta take care of something. Maybe I left the kettle on. I left the door on the microwave open. Something, anything. Your brain is going to throw something up as a distraction, and you're going to go and do that. And then you'll come back to the chart and say, oh, look at that, I was right, man. These optimal trade entries, man. Woohoo! This is it. Well, you wasted it because not only did you train yourself to look at things in a fearful light, now you're rewarding yourself subconsciously that you just did the right thing when you did the worst thing in that event because you didn't engage. At that moment, you should not even say anything about the trade or the market moving. Because you didn't take one and you didn't have a trade. You didn't engage, so there's no reason to talk about it. You can just annotate the chart afterwards, but never have any butterflies, warm fuzzies, that moment of elation that you think, oh yeah, I'm figuring it out. Because I'm going to tell you something, I spent years in that state of mind. And then what will happen is I get into a trade because something stupid has nothing to do with my trading plan. It had nothing to do with it. None of the things are even in my trading plan, but I got in wheat. Okay? I get in wheat. I'm selling short wheat. There's no reason to be selling short wheat. I have no reasons to justify it, but I felt like I had to do it. Why? Because I had so many opportunities that I falsely attributed to I was right, but I didn't engage. And then something subconsciously made me want to take that trade. And I can tell you, in my journals, I have dozens of those events in the 90s where I don't even have any reason for being in the trade. So it's almost like a self-fulfilling prophecy that you fulfill as a losing trader. You do all the wrong things. When you don't do the wrong things, you don't feel good because you don't even know what you're doing is wrong or right because you don't have any basis. You don't have a baseline. When you look at things with a idea that it should or might do this, and then you don't engage, and you come back later on and you say, oh yeah, I did that, I called that right, you're not growing. You're actually going the opposite direction. And you're building so much stuff that you're going to have to beat through as adversities because you're training yourself with bad habits. You have to engage. When you think the market's going to do something, you need to engage with an idea. Say, okay, this is where I think it's going to be a good buy or a good sell, and then where your stop would be, and then you monitor it Or if you can't watch it live, say, okay, this is where my stop would be, this is where my target would be, and let's see what happens. What transpired after that. Then and only then do you have feedback that's meaningful. Because you can't look at something and say, oh yeah, I thought it was going to go up, and then go on social media and say, yeah, I had that trade too, ICT, because I see a lot of that kind of stuff. And maybe for some of them they did, but for most of them, I guarantee you they're doing what I'm explaining right here. And that is something that I have never seen anyone talk about in any books. And that's why I don't really, like even Mark Douglas, okay, rest in peace, his book is always pointed to as the psychological Bible, okay, trade psychology. And it's got a lot of good things about it, but it really doesn't answer a lot of other things that, in my mind, are much more paramount. There are things that are in Alexander Elder's book. Like I said, in that book, the first portion of the book is the best part of that book, because it really zeroes in on this self-defeating loser's mentality. And even he didn't talk about this kind of stuff. And I'm not trying to beat my chest saying, look how smart I am. I'm just speaking from my own experience, because I have lost fortunes. Okay, I've lost so much money and time doing stupid things. And I wish I could go back and slap myself around and say, don't do those types of things, and do these things, okay? But we, especially as Americans, and predominantly males, okay, women don't usually have these problems I'm talking about. They do, but they have a slightly different spin on it. But men basically like to be right. They have that caveman mentality. They go out and they club something over the head and they drag it back to their cave, and it's theirs. Well, the market isn't like that, for someone that hasn't trained themselves properly. Like, you can't just sit down and say, okay, it's New York Open, I'm going to go in and I'm going to take an optimal trade entry. Why? Why should it be an optimal trade? What makes it optimal? That's what I've been talking about here. And I honestly believe that it's these lessons, okay? And I'm not asking for you guys to say this on Twitter. In fact, I don't want you talking about it at all, actually, okay? But I don't want a glad hand. I don't want a pat on the back. I'm telling you what you need to know. And I believe that it's these lessons, the ones I'm giving you right here. I've been talking to you almost an hour now, and this chart has not changed. Your chart is not frozen. Okay? It's just, I want you to understand how you can do something, and it feels like you're doing something constructive, but in fact you're actually being destructive. You're building so many layers, okay, of confusion and false sense of security, that when you start to really engage, you're going to be relying on what experience and what exposure. False experience, pseudo success. You can't fake this, folks. You have to do it for real. And in the beginning, you should just get into the habit of saying, okay, I don't know what's going to happen today. When I get in there, I'm going to practice, and I'm going to take something good from it. And if you have that mindset going in, and you think about what it's done, it's freed you up. You might not get it right, and you've already accepted it going in. Now, as a man, what you're doing is, well, I think it's going to go up, but I am scared to co-sign on that. And even though it's just me doing it, I can't accept the fact if I'm wrong. So I just want to see if it does, and then I'll just say I was right after the fact. And that's not teaching you anything except for reinforcing fear. Period. That's all that is. You are training yourself to be a fearful trader. In fact, not even a trader. You're training yourself to be fearful. And that creates a welcome wagon of floods of anxiety, performance issues, where you won't be able to, once you do get in a trade, you'll be reluctant to hold it. And that's usually what takes place. Like, for someone that puts these types of framework into their study, and they say, okay, I'm going to be distracted for a couple minutes, I'll come back and see what the chart says later on. And if it does move where you thought it was, and you start telling yourself, yeah, I'm smart, where is the link to that as experience that you're going to use going forward? Because the positive feedback isn't based on you engaging. The positive feedback is that you made a guess but took no part in entering it and framing it with a stop and letting it go and then watching it or allowing it to trade after that. So there is no feel-good moment about that. There's zero. So you don't have a deposit in your learning, but what you're doing is you're falsely attributing success and accuracy when it didn't exist. Because if you were accurate, or if you had faith in what you were thinking you were expecting to see, you would have engaged in it. But because you didn't engage, what has it done? It's shown you that you're fearful. So your subconscious is remembering what? I'm afraid to take that trade. I'm afraid to engage. Wait until later on. So what happens? The trader waits later on. And then they start doing what? They chase the marketplace. I just outlined what every book out there cannot do. Why do people lose in trading? I just explained it. In the most direct, no fluffy, no, sniper jargon added to it. It's just real world, because I know I lived it. I absolutely lived that. And I know how to fix it. And it's not in those books, because those books don't talk like this. Those authors, they didn't really lose fortunes. they probably never traded. Okay, so when you practice, you have to be all in and engaged and accept it. But when you see situations where you have two areas of sell-side liquidity ran out, and then you have an optimal trade entry with an objective that likely could send price higher, you have a very loaded deal, okay? Or in Larry Williams' terms, a lead pipe cinch trade. It's like smashing it over the head with a lead pipe. It's getting knocked out. Okay, not too many people can withstand a lead pipe to the head and maintain consciousness. And that's what you're doing. You're looking for those setups that give you context that agrees with your objective in terms of where the market's reaching up or down, bullish or bearish, and then the time of day, New York, and then what do the signatures look like, the things I'm showing you here. You may not get two levels of sell-side liquidity taken out. You may just have the one to base it on, and that's fine. But if you ever get two and it's still bullish and you get an optimal trade entry and you have fair value gap and bullish order block and optimal trade entry framework where you're now in a discount market, you need to engage. You need to frame it, say, okay, here's where my stop would be. Boom, I'm in there. Think about it. When this swing low was formed, you could be a buyer down here and the stop would be right below here. But what happens if you waited for this to run up and it takes this high out and then it starts to come back down and you use this as your entry? Where would your stop loss be? Right below here. So when this takes off, then you can move your stop up to here if you started over here underneath this low with your stop. So I've given you a lot to think about in this, and you need to watch it a couple times. Don't worry, I'm not getting any ad revenue. It's something that is absolutely paramount to you. Number one, trusting what you're trying to do, and also receiving what it is you're supposed to be receiving when you practice, and practicing correctly, not just saying, yeah, I thought it was going to go up, it did, and I'm going to go out and tell everybody I was right, or even tell yourself that you're right. Don't do that. Now, some of you may be arguing with yourself, well, isn't that what you're basically trying to do? You're trying to trick your brain? Because if I look at something and write down everything in hindsight, I'm saying, no, totally different examples there. What I'm stating in this discussion today was the moments when you see a chart and you think right away, okay, I think it's going to go up right from where it's at right now, and it shouldn't go down from where it is. But you don't do anything with it. Then you come back later on and say, see, I was right after it's moved. That is wrong. But if you look at something in hindsight entirely 100% and you weren't there when it happened, and then you annotate your chart and you save it in your journal that way, that is not the same thing, because you weren't there when that chart was starting to morph into a setup. You weren't there attributing bullishness or bearishness to it. You're feeding your subconscious at that moment what it looks like after the fact. That is actually constructive. What I've been discussing in this teaching today is absolutely destructive, and you want to avoid that. All right, so hopefully you got something out of this one. I will touch base with you tomorrow with the midweek review. Until then, I wish you good luck and good trading.